Ever pondered why capital budgeting plays a pivotal role in healthcare? Let's dive in to uncover the answer. Capital budgeting, also known as capital investment analysis, is the backbone of any healthcare institution's financial management. It's like a compass, guiding healthcare institutions on their journey toward financial health. This process involves the evaluation and selection of long-term investments that align with the overall strategic goals of the institution. By meticulously assessing potential investments, capital budgeting helps healthcare providers allocate their resources effectively, ensuring that every dollar is put to the best use. Whether it's for purchasing new medical equipment or building a state-of-the-art facility, capital budgeting helps in making these critical decisions. Moreover, it's a key player in strategic planning, helping to forecast future expenses and revenues, and ensuring the long-term financial health of the institution. So in a nutshell, capital budgeting is not just about numbers, it's about ensuring the sustainability and growth of healthcare institutions. Capital budgeting provides a roadmap for financial success in healthcare. The payback period, a straightforward yet powerful tool in capital budgeting. Do you know how it works? Let's think of the payback period as the time it takes for an investment to return its original cost. It's a bit like a friend borrowing money from you. You'd want to know when you'll get your money back, right? In capital budgeting, this is a method used to determine the length of time it will take for a project or investment to pay back its initial cost outlay. The formula is quite simple. Divide the initial investment by the annual cash inflow. The result is your payback period expressed in years. Imagine, for instance, a hospital wants to invest in a new MRI machine costing $2 million. The machine is expected to generate an annual cash inflow of $500,000. Using the payback period formula, we find that it would take 4 years for the hospital to recoup its initial investment. Now, the payback period method is loved for its simplicity. It's an easy and quick way to assess an investment's risk and liquidity. It allows decision makers to get a quick sense of how long their funds will be tied up, which is particularly useful in industries like healthcare where liquidity is crucial. But, like all things, it's not without its drawbacks. The payback period doesn't take into account the time value of money. It also doesn't consider cash flows that occur after the payback period, potentially neglecting long-term profitability. Moreover, it doesn't provide a concrete decision rule to determine if an investment increases a firm's value. So while the payback period may seem like a simple, straightforward tool, it's essential to consider these limitations when using it. Remember, no single tool should be used in isolation. While the payback period may lack in sophistication, its simplicity and ease of use make it a go-to technique for many. Now let's move on to the next capital budgeting technique, shall we? Net present value, or NPV, sounds complex, doesn't it? Let's simplify it. Imagine you're part of the decision-making team at a hospital. You need to decide whether to invest in a new MRI machine. It's a big decision with a hefty price tag. This is where net present value, or NPV, comes into play. NPV is a method used in capital budgeting to analyze the profitability of an investment or project. It's calculated by subtracting the initial investment cost from the present value of expected future cash flows. The formula looks like this. NPV equals the sum of future cash inflows, discounted back to present value, minus the initial investment cost. Let's break it down. The present value is the value in today's dollars of future cash inflows. These are discounted using a discount rate, which accounts for the time value of money. The time value of money is a financial concept that $1 today is worth more than $1 tomorrow. For example, let's say our new MRI machine costs $2 million. We expect it to generate $300,000 in net cash inflows each year for 10 years. If we use a discount rate of 5%, the NPV will tell us whether this MRI machine is a good investment. But like all methods, NPV has its benefits and drawbacks. Its main advantage is that it takes into account the time value of money, providing a more accurate picture of an investment's profitability. It also considers the total projected cash inflows, not just the payback period. However, NPV also has its limitations. It can be difficult to accurately estimate future cash inflows and the appropriate discount rate. Plus, it's a bit more complex than other methods, which might make it daunting for some. Despite its complexity, the NPV method provides a comprehensive analysis of an investment's profitability. So next time you're faced with a big decision like whether to buy that new MRI machine, remember NPV. It could be the tool that leads you to make the best decision for your hospital. The internal rate of return, a key player in investment decisions, but what does it really mean? Let's dive right in. The internal rate of return, also known as IRR, is a capital budgeting technique used to estimate the profitability of potential investments. It's like the interest rate that makes the net present value of all cash flows from a particular project equal to zero. Now let's talk about the formula. The IRR can be calculated by setting the net present value equation to zero and solving for the discount rate. This might sound a bit tricky, but in reality, it's pretty straightforward. Remember, the goal is to find that magical rate where the sum of the present values of future cash flows equals the initial investment. Let's put this into a hospital context. Imagine a hospital is considering an investment in a new MRI machine. The machine costs $2 million and it's expected to generate $500,000 in net cash inflows each year for the next 5 years. To calculate the IRR, we would set the net present value of these cash inflows equal to the cost of the machine and solve for the discount rate. If we find that the IRR is higher than the hospital's required rate of return, then it's a thumbs up for the project. If it's lower, then it's a no-go. Now, the IRR method isn't without its drawbacks. One of the main criticisms is that it assumes the cash inflows from the investment are reinvested at the IRR itself, which may not always be the case. It can also give misleading results when comparing projects of different sizes or timings of cash flows. However, the IRR method is still a powerful tool for comparing the expected profitability of different projects. It gives you a single percentage figure to quickly compare against other potential investments or your required rate of return. And who doesn't love simplicity? The IRR method, a powerful tool for comparing the profitability of different projects. And with that, we wrap up our discussion on the internal rate of return. Let's move on to our next topic, shall we? The Modified Internal Rate of Return and Profitability Index, two methods that provide a nuanced view of an investment's potential. Let's start with the Modified Internal Rate of Return, or MIRR for short. It's like the internal rate of return's more refined cousin. While the IRR assumes that the cash flows from an investment are reinvested at the project's own rate of return, the MIRR provides a more conservative estimate by assuming that reinvestments are made at the firm's cost of capital. Now, how do we calculate it? The MIRR formula requires 3 inputs: the finance rate, the reinvestment rate, and the cash flows of the project. It's a 3-step process. First, we calculate the present value of the cash outflows using the finance rate. Second, we calculate the future value of the cash inflows using the reinvestment rate. Finally, we find the rate that equates these two values. Consider a new hospital wing project. The initial investment is substantial, but the expected future inflows from increased patient capacity could offset this. Using the MIRR method, a hospital administrator can better gauge the project's return, taking into account the cost of capital and the returns from reinvestment. Now, onto the Profitability Index. This method is a ratio of the present value of future cash inflows to the initial investment. It tells us how much value we get per unit of investment. If the profitability index is greater than 1, the project is considered profitable. For example, suppose a hospital is considering investing in a state-of-the-art MRI machine. By calculating the profitability index, the hospital can compare the value generated per dollar invested in the MRI machine versus other potential investments. However, it's important to remember that both the MIRR and profitability index have their limitations. They require an accurate estimation of future cash flows and the correct discount rate. Despite these challenges, they offer valuable perspectives on investment decisions. The MIRR and Profitability Index, valuable techniques for a more in-depth analysis of capital budgeting decisions. So, we've journeyed through the world of capital budgeting techniques. What have we learned? We've seen how the payback period can give us a quick snapshot of when an investment will break even. It's like a hospital's heartbeat, giving a simple, steady rhythm to guide our decisions. Then we delved into the net present value, which adjusts future cash flows to today's value. It's like the blood pressure of our investment, showing us the true health of our financial choices. Next, we explored the internal rate of return, the discount rate that makes our net present value zero. It's like a hospital's pulse rate, telling us how fast our investment is beating. We also discussed the Modified Internal Rate of Return and Profitability Index. They offer a more nuanced understanding, like a comprehensive health checkup, providing a complete picture of our investment's health. Capital budgeting techniques, a compass guiding healthcare institutions towards a financially healthy future.